You've probably heard it before, just buy a global index fund and forget about it. But when you actually sit down to invest your money, whether it's in an ISA, a SIP or a general investment account, it suddenly gets confusing. There are global funds, developed market funds, emerging market funds, synthetic ETFs, accumulation shares, and platforms charging all kinds of hidden fees. So how do you know which one is right for you? In this video, we'll break down everything you need to know in simple English. Chapter 1, what you're really buying. Let's start with the basics. When you buy an index fund, you're not paying a genius fund manager to pick stocks. You're paying for a list, a predefined basket of companies called an index that someone else has already created. Companies like MSCI, FTSE Russell and S&P Dow Jones decide what goes in that list, which countries, which sectors, which companies, and how much each one is worth inside it. Then fund managers like Vanguard, iShares or Amundi simply buy everything on that list. They track it automatically. No predictions, no guesswork. So if you buy a Vanguard FTSE All World ETF and someone else buys an iShares MSCI ETF, you're both investing in almost the same companies. The only real difference, the index provider, FTSE versus MSCI, and the fees your fund charges. And that's the key insight. With passive investing, performance is driven by the index, not the fund manager. If two funds track the same index, the performance difference is usually less than 0.1% per year. That means what really matters isn't which brand you pick, it's the cost, the structure, and the platform you use to hold it. If this is hard to understand, by the way, pause the video and take some notes. It's important and will help you invest and build long-term wealth so you can potentially retire early and live life on your own terms. Chapter 2, global doesn't mean equal. So what's inside a global index fund? Most people imagine it's a fair mix of countries, a bit of the US, a bit of Europe, a slice of Asia, maybe some emerging markets. But if you actually look under the hood of something like the MSCI All Country World Index, ACWI, you'll see a very different picture. Right now, the United States makes up around 64% of the entire global stock market. Japan adds around 5%, the UK about 3%, and France and Germany around 2% each. The percentages will vary from time to time, so don't quote me on them. This is just to give you a good idea of what makes up the overall global stock market today. And most of the world, Africa, South America, much of Asia, barely registers. That means when you buy a global index fund, what you're really buying is mostly the US, the world's biggest top performing stock market. This isn't necessarily a bad thing. The US market has been dominant for decades thanks to innovation and strong profits. Think Apple, Microsoft, Amazon, Nvidia, but it does mean your portfolio is more concentrated than it probably sounds. So next time someone says, I've gone global, remember, global doesn't mean equal. It means weighted by market size. And that weight is mostly American muscle. If you want to know all about money and investing, if you want to potentially retire early, hit the subscribe button and let's build wealth together. Chapter 3, the power and pain of fees. Once you've picked your index, the next thing to compare is cost, because costs are one of the few things you can control. Even a 0.1% difference in annual fees might sound tiny, but over 30 years, it can reduce your total return by thousands of pounds. Let's say you invest 100,000 for 30 years and the market returns 7% per year. At 0.12% fee, you'd end up with about 740k. At 0.25% fee, you'd have around 720k. That's a big difference. Loads of money gone just from paying slightly higher fees. But here's what many investors miss. Your platform can be more expensive than your fund. For example, on Hargreaves and Lansdowne, holding regular funds cost 0.45% per year, up to 250k, but holding ETFs is capped at just £45 per year. So if you've got more than 10 grand invested, ETFs are usually cheaper. Platforms like Invest Engine, Trading 212, or Lightyear are ETF only, so you can avoid these high fund platform fees altogether. Before you pick a fund, always check the fund fee, the ongoing charge or OCF, the platform fee for holding it, and whether you're buying an ETF or an EIC, because that alone could change your total cost by hundreds of pounds a year. As always, nothing in this video should be taken as financial advice, and the full disclaimer can be found below in the description. This video is all about education, and yes, it might be boring for some people, but it's important. Investing into assets is hugely important because it protects you against the current broken financial system. Chapter 4, Developed versus Emerging Markets. Here's a big question. Should you include emerging markets like India, China, or Brazil in your global portfolio? The argument for including them is simple. These economies are growing faster, so their companies could offer higher long-term returns. But here's the catch. Growth of the economy doesn't always mean growth of your investment. Emerging markets often have higher political risk, less stable currencies, and more expensive trading costs for fund managers. All of that can eat into returns. That's why funds that include emerging markets, like Vanguard's VWRP, usually have higher fees, around 0.22%. Meanwhile, developed-only funds like Vanguard VHVG charge just 0.12%. And since emerging markets make up only about 10% of the global index, they'd have to massively outperform to make a real difference. So for most UK investors, skipping them isn't a big deal and can save you money. You can always add a small emerging market fund later if you want extra diversification. Remember, keeping it simple often beats chasing complexity. Chapter 5, Understanding Withholding Tax. Now we're getting into something few investors ever think about: withholding tax. This is the tax the US takes off dividends before they even reach your account. Since about 2/3 of your global fund is in US companies, this really matters. If your ETF is domiciled in Ireland, you'll pay 15% withholding tax on US dividends. If it's domiciled in Luxembourg, that rises to 30%. So if your fund yields 1.5%, you're losing 0.45% of that income every year. Over 30 years, that compounds into a huge difference. Some ETFs get around this by using synthetic replication. Instead of owning the shares directly, the fund holds a contract called a swap with an investment bank that mimics the index's return. Because the shares stay on the US bank's books, no withhold tax is applied, so your returns can be slightly higher. But there's a trade-off. Synthetic funds have counterparty risk. If one of the banks in that swap, say JP Morgan or Goldman Sachs, were to collapse, the fund could suffer a small loss. It's rare and the risk is spread across multiple banks, but it's still there. So here's the rule. If you're experienced and understand synthetic ETFs, they can make sense. If not, stick to physical ETFs. They're simpler, safer, and tax efficient for UK investors. Chapter 6, How to Compare Funds. Now that you understand how global funds actually work, let's go step by step through how to pick one. Step 1, pick your index. Decide whether you want a truly global tracker like MSCI, ACWR, or FTSE All World, a developed market only fund. If you want simplicity, go global. If you want to shave costs, go developed only. Step 2, compare fees. Look for total ongoing charges under 0.2%. Anything higher should be justified by something meaningful, like smaller size or special coverage. Step 3, check your platform. Make sure it actually offers the fund you want and compare what they charge for ETFs versus funds. For example, Vanguard Investor Only offers Vanguard funds and ETFs flat 0.15% platform fee. Invest Engine offers a wide range of ETFs and zero platform fee. Hargreaves Lansdown and AJ Bell charge higher for funds, lower for ETFs. Step 4, choose accumulation versus income. If you're building wealth, choose accumulation units. They automatically reinvest dividends. If you want income, go for income units. Step 5, stick to sterling. If possible, choose the version of the ETF listed in GBP on the London Stock Exchange to avoid foreign exchange fees. Right now, the Amundi Prime Global ETF is one of the cheapest at 0.05%, but it pays income. Chapter 7, Global Fund versus Life Strategy. Now let's look at a common debate. Should you buy a single global equity fund or a multi-asset fund like Vanguard's Life Strategy? A global equity fund gives you maximum long-term growth, it's 100% stocks, and it's fully diversified across countries and sectors, but it's also the most volatile. In contrast, life strategy funds mix stocks and bonds, and you can pick your risk level. Life strategy 20 equals 20% stocks, 80% bonds. Life strategy 60, 60% stocks, 40% bonds. Life strategy 100 equals 100% stocks. This is the fund I've invested into for me and my two daughters since 2019. The beauty of life strategy is automatic rebalancing. If stocks go up and bonds go down, the fund quietly sells some stocks and buys more bonds, keeping your portfolio balanced without you lifting a finger. For beginners, that's really powerful. No worrying about market timing or panic selling after a crash, but there are a few trade-offs. Life strategy has a big UK bias, around 25% of its equity is in UK stocks, compared to only 3% in the global index. It doesn't include commodities like gold, which can act as a buffer during inflationary shocks, and at 0.22% per year, it's slightly more expensive than most ETFs. Still, for most investors, especially those who want a set and forget solution, Life Strategy 60 or 80 is an excellent starting point. It's globally diversified, balanced, and keeps your emotions out of the equation. Chapter 8, which one's right for you? So how do you actually decide between them? Choose a global index fund if you're young, 20s, 30s or 40s, and can stomach volatility. You have decades to invest and want maximum growth. You already have other safe assets, cash, a house, or a defined benefit pension. You understand that market crashes are opportunities to buy more, not reasons to sell. Choose Life Strategy or a multi-asset fund if you want simplicity. One fund that does it all. You prefer smoother, less stressful returns. You're investing for medium-term goals or retirement in 10 to 20 years. You know, you might panic in a market crash. Remember, you can't control markets, but you can control your behavior. The right fund isn't the one with the highest performance, it's the one you can hold through both booms and crashes. Chapter 9, putting it all together. So here's your simple framework to choose the right index fund. 1, define your goal. Long-term growth, income, or balance. 2, pick your index. MSCI, ACWI, or FTSE All World are safe bets. 3, compare costs. Aim for under 0.2% total. 4, check your platform. ETFs often win on fees. 5, stick with it. Consistency beats cleverness. If you're unsure where to start, a global ETF like Vanguard FTSE All World, VWRP, or SPDR MSCI is hard to beat for simplicity and diversification. If you prefer buy, set it and forget it, Vanguard Life Strategy 60 is a solid one-fund portfolio for most people. Either way, the hardest part isn't picking the fund, it's staying invested long term. So once you've chosen, don't fuck about, let time and compounding do the heavy lifting. All I would say is to read a few books on index funds, and this will give you even more confidence to go alongside this little video. And if you want my top 5 investing books, type yes below in the comments.